Welcome to Protect Your Assets Market Briefing. I'm your host, David Hollander, also known as the Sandman. Now let's get started. Well, stocks staged a pretty nice little rally this past week as corporate earnings continued to surprise and look pretty good. We had the Dow up 1.3%, S&P up 2.4%. Year to date, we're up 8.6% on the S&P. NASDAQ had a nice little rally, up almost 4% to be now up year to date 11.1%. I can remember not too long ago we were down over 20%. MSCI International Index had a nice week, up 2.3%. Year to date, it's up 17.8%, the clear leader overall. The 10-year note at 4.28%, and oil slipped this week, down 5.5% to close at $63.60 a barrel. So earnings continued to be stronger than expected as 82% of the S&P 500 companies have beaten analyst estimates with an average upside surprise of, get this, over 8.5%. As a result, forecasts for earnings growth have been revised sharply higher, 9.7%. And this was, they were saying 3.8 before, so 9.7 is a big jump at the end of this quarter here, showing that prior downgrades, well, they were a little bit overdone. This past week, we also saw the manufacturers index and the service index, both measures of the economy overall, show that the economy is still looking pretty good. No recession in the future here, and that helps stocks as well. So, what might be an area to look at right now that valuations are so high? Well, there are some specific stocks that could be winners as a result of what's developing in the bond market, and that could continue if the Fed lowers rates. I'm referring to the yield curve. Now, this keeps steepening when you look at the difference between the 2-year Treasury yield, right now around 3.7%, versus the 10-year yield of 4.28%, as I just mentioned. So we call that a steepening yield curve since the 2-year Treasury is lower than the 10-year Treasury. And if you were to plot that out on a chart, you'll see literally like you're going up a hill. The 2-year has declined on a combination of things like the Fed cutting rates. Again, expectation hasn't happened, but the market's expecting it, and we've had pretty stable inflation. So those things have become a tailwind on stocks, and there's a few areas that you might want to look at moving forward, particularly if the Fed goes ahead and lowers rates as they are expected to. So what are the areas you want to be looking at? First, banks. Put simply, banks borrow in the short term and lend in the long term. So that fact that short-term rates are falling and are likely to continue to fall will be positive for bank margins. You may want to write this down. KBWB, that is an ETF of banks, and it is heavily weighted to the largest U.S. money center banks like Goldman Sachs, JP Morgan, Chase, Morgan Stanley, Wells Fargo, Bank of America, and Citi. All of these make up over 50% of that ETF I was talking about. And for a more diversified and smaller cap approach, the SPDR S&P Regional Bank ETF, KRE, provides regional bank exposure with rate cuts likely coming and a friendly administration in the White House. The outlook for banks, if the curve continues to steepen, is attractive. So key to this, though, is stable economic growth, as any deterioration in credit quality would be a negative overall for this trend. Now, remember, for all these ETFs, please go read the website, go look at the prospectus before you invest and make sure that it aligns with what you're trying to do. What else could be a winner? Well, the second area that we're looking at right now are small caps. Small caps are sensitive to borrowing costs, and that's because they need capital, and shorter term rates going down would benefit small caps. And to that point, most small companies have lines of credit. that are pegged to shorter-term interest rates. So they receive a outsized benefit of short-term rates falling more quickly. And if the Fed goes ahead and cuts rates as expected in 2026, this could be a tailwind that could last for the next several quarters. There are ETFs you can look at in that space as well. The index you're looking for is the Russell 2000. Third winner could be utilities and REITs. As long as the curve continues to steepen, these sectors' dividends will become relatively more attractive. In the case of utilities, this would add another bullish point to an already compelling case. What's an index to look at there? Well, one of the ETFs out there is XLU. This is also doing well given the power demand from AI companies. Bottom line, if the market gets the rate cuts it's expecting, not just this year, but next year, then we should see the curve continue to steepen, led by a decline in the 2-year, and that should put a direct tailwind on the sectors that we just talked about. So keep your eyes open for those. It could be exciting. And while the economy appears to be slowing down slightly, I expect a reacceleration in 26 and 27, supported by tailwinds of fiscal stimulus, Fed rate cuts, and deregulation, and of course the potential for reduced trade tension. So what are some things you may want to allocate your portfolio to? Well, again, this depends on your situation, your time frame, but overall, we still like U.S. large cap and mid cap stocks, which I believe should perform well in this sort of an environment. And within U.S. stocks, we like consumer discretionary, financial services, and healthcare sectors. And the strong performance of the international index, as we just covered, shows you why you want to be diversified. But overall, right now, you may want to lighten up on that a little bit and diversify amongst the other areas that I'm talking about. Within U.S. investment grade bonds, again, look at quality, consider extending your duration. Bonds in the 7 to 10 year range can offer the opportunity to lock in yields, higher yields for longer, and the possibility of price appreciation as the Fed likely resumes rate cuts with potentially less sensitivity to deficit concerns than longer term bonds.
You can hear the Protect Your Assets market briefing on your favorite podcast app or as an Alexa flash briefing. Just search for Protect Your Assets market briefing. Links to subscribe free wherever you listen are at libertygroupllc.com/PYA briefing. The following program is paid for by Liberty Group, and the views and opinions of the host do not represent those of the station or its ownership. Investment advisory services are offered through Liberty Wealth Management, an SEC-registered investment advisor. Legal information provided on the air is not intended to be a substitute for callers hiring their own lawyers to advise them about personal legal matters. The information provided is general financial comment and cannot be relied upon for your specific financial situation. Investing involves risks, including the risk of loss of your investment. Please consult with a financial professional before investing. California Life Agent number 0B48569. You're listening to the Protect Your Assets Radio Network.